We're live.
All right, are we live? The host has started this webinar live and in person. So who do we have so far? Got Arturo, got Mr. Parker Blackman, and Miss Stacy. So as always, gang, thanks for joining. This is our monthly, annual, quarterly webinar, whenever we get around to doing one. This is going to be a great topic because it's very fascinating what's been going on in the world. And as always, we typically do a couple, 3 minutes of just kind of warm up chit chat before we dive into the topic because webinars, people historically jump in late. So a couple of big things I want to bring up with RentWerx that are going on that are kind of new is we do have a new website, a new look to the website. Big mad kudos to Arturo for being able to put this whole thing together. He just had a meeting today with our web provider, and our numbers look very strong. And there was just a lot of things broken in the background. When you have an old website, 10, 12, 15 years old, I mean, that URL had been around for a long time. So the website gets, it's not really infested or infected. It's just more like not correct, is the best way to say it. Because there's a lot of broken links, there's a lot of old videos, there's just a lot of junk in there that can slow things down. And a lot of that has nothing to do with your rental property, but it is something to do with us as running a good business. You got to have a good website because we want tenants to find our properties on our website. And that was a big thing of why we decided to do that. Arturo, anything to add to this little update tidbit? I'm throwing it out there.
Yeah, it was as you mentioned a lot of old links that we had, and by doing this revamp, we are now pushing right on top of the Google pages, right? They are all about the metadata and backlinks and all that. So we're doing the work to be right in front of the tenants and the owners to, capture those leads. And of course, for tenants that are looking to rent a home, we're gonna be the first ones to be on their faces to, to find a home. So we're
Yep.
very excited and happy for this change.
Yeah, that's kind of the key point is we want to make sure our homes are seen and it's a clean website with good links to everything. There's nothing worse than somebody going to a website and they say, I do want to apply, and they click the link and it goes dead or it goes nowhere. So that generates calls for us. That's a frustrating thing for the potential applicant, and it reflects poorly on us. Not that this ever happened. I'm just throwing out an example of what could happen. I just remember, if you are ever shopping online and you go to like actually want to purchase something and a link doesn't work, you just like, meh, never mind, and goes find something else. So that's a great tidbit. I wanted to bring that up. The other fun, hot topic, what we got going on is the key leadership. That would be Melanie, Amy, and Stacy. They just went to a RentVine conference that was last week. And RentVine is our software provider that runs all of our backlog. Uh, all of our owners see this on the backside of with the owners portal. That's all generated through RentVine, and it helps us keep straight in our rent collections. It's basically the epicenter of our business. And the key three, they went to Florida and did a in-person conference with RentVine itself. So it's probably one of the most productive conferences because it's put on by the actual vendor that does the software. So it's not a generic, organizational conference where you hear from motivational speakers, right? You know, don't hear anything like that where they tell you to do your best while they live in a van down by the river. This was real world stuff, and I'm going to turn it over to Stacy to see what kind of she has on a couple takeaways.
Yeah, so it was a really good conference. Again, it was in Tampa, Florida, nice and sunny last week. And again, it's our main CRM software that we use. And there were several key takeaways there. One thing was that I've learned a lot of new processes. So Rentvine has a lot of processes built into their software, some of which we use, some of which we don't use, some of which we know of, but haven't taken the time to really dive into yet. So I got to see some demos on a few of those that I really want to try out. So it was nice to see those. Um, what else? What else? Updates on the application processing. So they talked a lot about what's coming in the future for their applications and what they're beta testing, what they're working on to make better. And they took polls from us directly as property managers. What do we want to see improve? So I thought that was really cool. I found out a lot of what other property managers are using for collection companies. Collection companies are such a squishy thing because it's so hard to find a good one, one that collects and actually gets payments. We have a pretty good one in place, but I'm always, looking around to see what else is out there for options. Um, and then the last thing I had that I thought was really cool, we sat in on a maintenance session. So we use Property Mode for our maintenance software, and the CEO of the company shouted us out specifically because of our just how well we perform overall as a company in that software compared to other local property managers, well, local and across the nation. So I thought that was really cool.
Yep, that's pretty good. Great stuff on that. We know the CEO pretty well. He's a former West Pointer, and so he and I have a lot in common there as far as serving the military once upon a time. And really neat stuff on the application side because it kind of goes sight unseen where everything's done in the background and the owner's like, okay, here's a good application, but the screening process is super diligent. And if we have really good applications and good software to run those applicants, we can find the best applicant for the owner. Naturally, we choose the best applicant, not the first applicant, and that's going to get us good tenants. Good tenants pay on time, they renew. I mean, it's just a healthy life cycle there. So I want to talk, let's transition now into why we're here. So we're going to do a webinar this afternoon called cost segregation. Okay, so this is a tax term that is a study about what's going to be depreciated in a home. And I probably butchered the explanation, but I did bring out an expert and I'm going to introduce him and he's going to tell us who he is, what he does. And then we're going to get into explain what exactly is a cost segregation and why it would be a right fit for you and kind of some of the ins and outs. We know he'll go back and forth with me and on the conversation. You get to listen in. At the end, you're going to be able to obviously you can contact this company and they can run some information for you. It's it's going to be something that I'm doing personally. So I have a couple stories that could show you where this fits in, and it all has stemmed from a big change, which we're going to talk about as well. So I'm going to introduce Parker Blackman. Parker, could you go ahead and give us a few minutes about who you are, what you do?
Yeah, for sure. Absolutely. Thank you for the introduction. I work with a firm called Remote Cost Seg. We're a cost segregation firm. We'll get into what that really is in a minute. But yeah, I mean, we're working with the everyday investor up to, very high net worth individuals with large commercial properties. So yeah, there's a lot of broad ways that this can be utilized, and I'm excited to dive into it a little bit further.
Great. That's awesome. So let's talk through why this is all of a sudden important.
hmm
And so I'm going to kind of throw it out there to what I understand. I do pay attention to politics, and of course, we have a new administration that's been there for almost a couple of years now. And one of the things that got passed last year, that would have been in 25, was the big beautiful bill. And so that got pushed through both houses, and of course, the president signed it right away. And there were so many good things in there between no tax on tips, no tax on Social Security. I mean, just some common sense things that were in there. And then they did a pretty neat situation to where they made some changes to how we depreciate properties. It was no longer at a 5 or 7 or even 27.5 year pace. They allowed you to fast forward a lot of that. So, Parker, tell us more about what you understand what that did.
Yeah, yeah. I mean, so that was one of probably the biggest things that really brought a lot of eyeballs to this because it was a really mainstream policy. It wasn't just something that was swept under the rug or anything like that. It was like overnight, a lot of people were like, what is this? What does it mean? And what the heck is cost segregation? So I mean, a lot of people came to us and I mean, in plain English, without getting too lost in the weeds, what that really did was instead of only being able to depreciate a small chunk of your depreciation over a longer period of time, you were able to take 100% of certain components within your property all up front in year one. So what that really equated to was instead of people having things like cabinets or landscaping or things that have a much shorter life have to be spread out over 30 years or more, they were able to take those deductions in year one, which translated massive in terms of what their tax bill was at the end of the year. Right.
Yeah,
So,
and then we're going to dive into that, kind of what that means with the numbers and
sure.
how it works, and we'll get to that point. But I think this has been answering the question we've been looming on for a couple, 3 years at least in the San Antonio, Austin regions is what incentives do investors have to buy single family homes?
hmm
I get if you are a reluctant landlord, an accidental landlord, that makes a lot of sense. You just bought the home a year or two ago, and then now you got a PCS, or you got to move, or you just want to buy something different, upgrade, and to keep the home as a rental. That's a great point. But for a lot of years there in the 2000s and 20s, 2010s, the teens, investors, they were flocking here. They were buying up HUD foreclosures and they were buying up all kinds of different things with the intent to turn those into long-term rental properties. The
Hmm.
other side of that is our property taxes are still high, and we no longer get the magic 1% rule. So, Parker, you and I talked about this a while back. It used to be where you could buy a $200,000 home and you could rent it out for 1,800 bucks, 2,000 bucks. Buy a $100,000 home, you could rent it for 1,000 bucks. Way back when the margins have really shrunk. And so now you're almost looking at a 0.75 to a zero point 0.5. And in Austin, it's really difficult. A $500,000 home is going to get you a couple thousand bucks, 2,500 bucks in rent. So it's a very difficult ratio. And the magic that people don't see is one, appreciation with an A, and two, depreciation. And the I can't say it now. Depreciation, right? The depreciation is now, I would say, quadrupled, it's 10x
Right.
because you can take that and fast forward it into year one. So it allows you to take over a residential rental property and make it either a long-term rental or a short-term rental or a commercial building or whatever it is. And so that's the other thing that a lot of people think cost segregation is just for like a commercial building. It's for a Walmart, right? It's for a storage unit complex. It's for an apartment complex. It's not for me, the average investor who has a couple of rental properties that are residential homes. And
Sure.
so, riff a little bit for me, Parker, on kind of what else I missed out of that explanation.
Yeah, I mean, I think it's like you said, just to touch on the first point you made. I mean, your average investor is really just looking at cash flow from the standpoint of what can I charge in rent and what are my expenses, right? And they kind of stop there, right? But really, your more savvy investors are looking at the whole picture. They're looking at the appreciation and they're looking at the depreciation. Most investors that I speak to, even if they're not killing it in terms of cash flow from their rental properties, they're making W-2. Maybe they sold some stocks, they have some capital gains, they have other areas that they're invested in where they're having to pay a lot of money in taxes. So a lot of people are sitting on tens or hundreds of thousands of dollars in tax savings from their rental property. And I speak to people all the time that are knowingly going in and buying a property, knowing that it's only going to break even at best, right? They may even, from a cash flow standpoint, from the rental income, they may come down a little bit lower at a loss. But when you actually go in and do a cost segregation study and look at how much it allows you to save on your taxes, it's astronomical, in terms of looking at how the math breaks down. Okay, maybe I only made 2 grand or broke even on my property this year, but because I bought that property, I was able to save $100,000 in taxes that I otherwise would have owed if I hadn't bought this property, right? So
Yeah,
people are going into this knowingly that, hey, if I break even, that's fine because the depreciation here is really what I'm looking for, right?
yeah, and that's something we've been preaching for years and years. I think breaking even is good.
Hmm.
The rule of thumb is you're going to be upside down at 10% down, break even at 20%. And if you put 30 or 40% down, yeah, you're going to cash flow. But I think breaking even is fantastic because, again, the magic of appreciation is something that's unforeseen. If you own something for 5 years or 10 years, it's a sideways pyramid. You have
Hmm.
appreciation going up, you have what you owe on the property going down. And then in the middle of that sideways pyramid, you get depreciation and write offs. And the write offs are now 10x. I mean, it's going to be hard to quantify. It's going to be specific to your tax situation because this is really meant for the person or couple that have kind of higher up in the food chain of earnings. And that could be W-2, that could be self-employment, that could be business, that could be royalties, that could be anything. But if you end up having to pay Uncle Sam a lot of taxes, either through your company in deductions and or at the end of the year, you're writing a giant bill to the treasury, this is something for you. And there's going to be a lot of squishy points we bring up. This is not like, pay a dollar to save two. It's not that easy. It kind of it depends is all over the place in this explanation of what cost segregation is. It depends what it costs, and it depends on what you earn to make it finally come down to it depends if this is worth it, and it depends on how much you're going to save. So it's not like we can give you concrete answers on anything. If you own a $200,000 home and you pay Parker X, you're going to save 20,000 in taxes. It's just not that simple. Parker, what do you got to add on that?
Sure. Yeah. I mean, I would say in general, though, if you have a property that you've had rented for 5 years or less, and you purchase for, say, at least 200 grand or more, if you meet both of those criteria, it's definitely worth at least investigating, right? And someone like our firm is willing to go in and gather all of the data that would be necessary to give somebody a preliminary estimate. So a lot of people come to us and they're like, I have no clue whether this would work for me or not. Some people are maybe even hesitant, right? They're taking the negative standpoint of like, I doubt this will work for me. My CPA said it wouldn't be worth it because I don't own a skyscraper or some crazy NFL stadium, and they don't even know that they're sitting on, like I said, tens or even hundreds of thousands of dollars of tax savings.
Yep.
So
Couple good points to bring
yeah,
up. So I want to bring this up. The first part is they just need to get in touch with you to find out if it's worthwhile,
right.
right? Because we can't tell them on a podcast or a webinar that
Sure.
it's going to be worth your while, 100%, because we don't know their tax situation, we don't know their property. But this is a huge opportunity to find out because of the big beautiful bill and the changes that have been implemented into the tax law. This is a big thing. Now, I wanted to correlate that with, okay, how does it work? So Parker gets you a cost segregation and you give it to your CPA, and it's literally plug and play. So the
Mhm.
CPA takes the numbers, puts that into their tax software, and it's line by line. Boom, 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 boom. Okay. And then you're going to see your tax bill decrease. Okay. Because a lot of that is written off in the first year. Now you can only do this once. Parker, take it away on how many times you can do this.
Yeah, yeah, no, I mean, it's definitely important that you work with the right firm, right? Because, once you do it, it's not really like you can go back and reverse it or continue doing it. Yeah, it's definitely important that you work with the right firm. I would say that that's the number one important thing, to do your due diligence and, just to give you a little bit of background, like we're doing engineered studies, right, which are the golden standard from the IRS, which is basically bulletproof from an audit standpoint and gives you the highest ROI, right? So, doing your shopping is definitely important and making sure that you're working with the right firm in that regard. But yeah, I mean, once you do this study, you're looking at being able to not only have a huge chunk up front, but it also does get spread out just like it would originally, right? So
Mhm.
20 to 30% typically is what you're going to see of your purchase price plus whatever improvements you've spent on the property. You would see that in year one and then continue to enjoy those tax savings going forward for the next 30 years like you originally would. So,
Yep. And this is not some late night seminar that we're trying to teach you this. This is straight from the IRS and the Treasury Department on how these things work. They're already built into the forms. Your CPAs will prepare what the numbers come and look at, and they'll just plug it right into the software. And it is, I feel it's not going to trigger an audit because this is a pretty good regimented system now. And Parker, if you want to talk about that, because there's two different things. You have a company that could just kind of fill in a spreadsheet and good luck, or you have an engineering firm like them and they can do a little bit more. So explain that for us.
yeah, exactly. So, I mean, there's a lot of different, really what the IRS cares about here is how are you coming up with your numbers, right? That's really what it comes down to at the end of the day. Cost segregation is absolutely legal. It's in the tax code. The IRS wrote it themselves, right? So it's really just a matter of the methodology of how you're coming up with the numbers. So, not to get super lost in the weeds, but if you're going the right route, which is doing an engineered study where you're having engineers and CPAs pull actual material costs and not just come up with willy-nilly numbers that are based off of some national average. If someone is willing to do the legwork to actually itemize all of these components and get you a bona fide report that actually has everything well documented, there's basically no audit risk. I mean, we've never seen a client of ours have an audit flagged as a result of them doing a study, and we've seen people have some huge losses and deductions being able to be taken, and that hasn't triggered an audit in the 20 years that been doing these studies. So.
Yeah. So that turns up into kind of the pyramid that it can create. Okay. So this is the formula now. If you kind of pay attention a little bit, imagine I'm drawing it on a flow chart behind me. And so you do a cost segregation year one of a property, and now all of a sudden, let's say you had, for easy math, 20,000 of tax savings. Just easy math. Okay. So that could be a 10% down payment on a $200,000 home. You take that cost savings of $20,000, you turn around and contribute even another 15 or $20,000 into it, and that's a down payment on another rental property. And again, the whole goal is to break even. If you break even in rent versus what you owe in a mortgage every year, that can pyramid very nicely. And again, the magic of that sideways pyramid with the appreciation and depreciation coming in every year, that's how you can build wealth using this technique. It can really be done rinse and repeat. And so I'll give you kind of what we did. So RentWerx built a commercial building. This was like 3 years ago. We moved into the building that we are in now. We own it. I own it. And did a cost segregation in year one. And that was a significant savings on what we ended up having to pay in taxes that year because it just came right off. It's kind of the bottom line. It comes off the bottom line at the end, right? It goes up in the top, but the end result is the bottom of the funnel to say, your bill would have been here, and I'm using hand gestures to go high. Now your bill is here that you have to write a check into the treasury. And that's significant because what could you do with an extra fill in the blank in your head? What can you do with that? Can you buy another property? Can you buy another 10 properties? Can you go on a vacation? Can you buy Arturo a new microphone? Who knows, right? There's so many opportunities, right, Arturo? He's like shaking his head at me like, this guy is too much. Anyway, so I think that's great stuff and kind of the why we're doing this nowadays, because for a while there we couldn't answer that. What's in it to buy these properties? The people that we're talking to get so frustrated sometimes because Stacy hears this all the time from owners. I'm not cash flowing. I'm losing money every month. I don't want to make a repair. I don't have any money to do this and do that. I get it. Times can be tough, but at the end of the day, if you can ride out and break even 5 years from now, 10 years from now, look what happened during COVID and all that the appreciation that we had. We had a seller's market. So historically, what we see is buyer, seller market goes up and down. And if you can ride through the low times and all of a sudden we get a high time and it's 10 years later, we always tell people, hey, this is a kid's graduation present, so they can go to college on. You can cash out a property and walk away with 100,000, pay capital gains on it, and there you have enough $67,000 left to pay for college, right? So that's kind of how the math works. And I know I'm using really big generic numbers, but I'm trying to answer the why in example form and going into some of the legalities of it. So what am I missing, Parker?
Sure. I mean, what I was something that really came to mind when you were discussing that was a lot of people are familiar with the Burr method, right? Buying a property, you renovate it, you reappraise it, and then you refi, right? And that gives you some cash to go, and then you keep snowballing that into property after property after property. So most people are familiar with that term. It's basically the same thing, right? So
Mhm.
you're buying a property. You instead of following the rest of the R's, you buy and then you do the cost seg, and then that puts maybe $50,000 back in your pocket. Like you said, you go buy another property the next year, you do another cost seg. Some people will do multiple properties in one year. Depends on your tax liability, right? So it takes a little bit of ingenuity to figure out exactly what your number is, but ultimately, at the end of the day, it's the same thing as the Burr method. You do the cost seg, get the tax savings, keep buying more
And
properties, and it just
and
goes on in perpetuity.
this is not just for properties that you buy today. Okay,
Right.
these are properties that have been owned for however long.
Yeah.
So if you bought a property in 2000 and there's some depreciation left on that, you can do a cost seg and shrink that down into first year. It really applies for the folks that have owned the properties probably less than 5 years, I'm guessing, Parker.
Yeah. That's
That's
typically the
where
rule of thumb, but I mean, it really depends, right? Like, I hate to say that, but it really does. So,
true.
if you have a rental property at all, I think you should definitely look into it because the worst you can find out is, okay, maybe it won't work for this property, but at least I know for the future what strategy I need to deploy. Right.
Yeah, and we're seeing this whole technique kind of blow up with bigger pockets. That's where you get the Burr technique, the buy, rehab, refinance, rent, repeat. So it's kind of a repeat, and injected into that, of course, is this cost seg, which allows you the extra cash flow to hit the second Burr and then the third Burr. Okay, I've done 3 this year. I'm gonna chill, and then all right, get prepped and do another one the next year, right? There's really no limit to how many you can do in a year as far as purchases. So, and there's no minimum, let's say. It doesn't have to be a $500,000 property. It could be a $100,000 property. But again, it depends, right? So don't quote me on that. It depends. And it could be any type of a property. It could be short-term rentals, long-term rentals, which we do manage both. So we manage long-term rentals, and we see a lot of our investors have these properties for years and years. And now we're answering the question for them on why you should buy another residential long-term rental property. The other side of that game is short-term rentals. And that's where it can get really interesting. And Parker may be able to kind of chime in on this, but so imagine you buy a property, $300,000, nice round figure, but you got to put in 30 or 40 or more of improvements. And I'm talking improvements not like new kitchens and new bathrooms. I'm talking like furniture and silverware and the things that make a short-term rental property that you're familiar with Airbnb and VRBO, those kind of situations where that's really where they can hone in on some savings. Because if
Hmm.
you buy the property, of course, you have that, they're depreciating the walls and the doorknobs and the windows and the roof. You know what I mean? They're depreciating that stuff. But then they're also taking the stuff you put in there, the beds, the couches, the chairs, the refrigerators. I mean, all those things that you are required to have to make a decent short-term rental property. And you might use that short-term rental property for yourself for 2 months out of the year, for 2 minutes out of the year. We were working with a client the other day, and he still had a job back here, or a business, excuse me, a business back here in the San Antonio region, but he was located out of state. And so his intent was to buy a short-term rental property here in the San Antonio region, come visit his business for a week out of the month or a week out of the quarter, and then have a place to go. And in the meantime, when he wasn't there, he's renting it out as a short-term rental property. So will it cash flow better than a long-term rental property? Meh. That's a whole nother webinar podcast we'd have to probably do to go through the differences of short-term rental versus long-term rental. You hear the claim to fame that short-term rentals will cash flow better than a long-term rental, but if you rent it out for long enough, that's the trick. We've heard 15 nights a month is doing pretty good. And so if you go below that, well, you might have just been better off in a long-term rental situation versus a short-term rental. Okay, more than we need to talk about there on the cost segs with long-term versus short-term. Anything else you want to add to that particular convo on either one of those two scenarios?
Sure. Yeah. No, I mean, there's definitely a lot to get into about short term versus long term. I always tell somebody like either one can work, right? Like that's the most important factor is like it really is suitable to your appetite and how comfortable you are managing those properties, right? At the end of the day. But really in general, short term rentals can work, long term rentals can work. I've seen just about every situation work in some way or another, whether it be a condo, a townhome, a single family home, a duplex, a triplex. Maybe someone's renting the basement in their primary residence, right? Maybe someone is has an ADU in the backyard, right? It's on their primary residence, but it's a separate structure where they have guests staying. I mean, I've seen countless examples of properties work in some capacity to this extent where they're able to cash in on the tax savings and enjoy the cash flow as well. So, yeah,
Yeah,
no, I think
it's
it's a good
it's
point you bring up.
yeah, it's quite amazing how things are going on these days. So I want to field a question here. What's the qualification criteria? Who is eligible to do cost segregation?
Sure. I mean, the short answer is really anybody can do a cost segregation, right? Whether you have a super huge tax liability or a meager one, whether you are somebody who has 20 properties or one property, ultimately it's available to you, right? As long as you have a property that is in service as a rental or as a business in some capacity, it is eligible for a cost seg study.
Yeah, and I would uh, not let your CPA poo-poo that idea. Okay, I
Yes.
would I would I would talk to the experts like Mr. Parker and just kind of find out. It's a free conversation. It depends is a lot of what we have to give for answers because it depends on if it's going to be right for you. It depends on what it's going to cost, and it depends on what your cost savings are going to be. Where you're writing the check into Uncle Sam at the end of the year, and so
Mhm.
that's going to be kind of it depends the entire circle of it. But I would think it'd be worth investigating for sure in any one of those scenarios on short-term rental, long-term rental. And once you kind of see the tax savings appear, if it's right for your situation, that's going to be like, okay, this answers the question why I own this thing now. I'm ready to go buy more. And that's where we
Right.
can help you at RentWerx is we are able to help you go buy more properties. We have a sales division. We can help you buy properties in the long-term rental game or the short-term rental game. And same thing with our owners, if they're like wanting to step away from ownership now, this may be another opportunity to do that because there are investors looking for, and not rob you blind deals, but there are investors looking for good rental properties with good history. That's one thing when you work with a solid property management company like us. the history of a rental property is very easy to convey to a new buyer of like, here's all the maintenance work that was done. Here's the list. Here's all the rental history that was done. Here's the tenant ledger for the last however many years. And you could take over that particular lease agreement and be a new owner, right? So we get those properties a lot where the most common scenario is a VA owner. They got PCS to the East Coast. They want to buy another property wherever they got PCS to, and they have a VA property here in the San Antonio region. Well, I get it. That makes total sense. And sometimes those are tougher to sell because they don't have a lot of equity in there to play with. And so they may just need to get rid of it, and a new investor slash owner could come in and buy that property from them with a tenant in place. So that is a very common scenario as well. And again, it kind of goes back to the answer of why you want to look at more rental properties, because this is a huge deal, and it's amazing that nobody's talking about it. I think Stacy and our key leaders, Melanie and Amy, they went to the conference, and this was just last week with the RentVine conference in Florida, and not a lot of people were talking about it. According to them, it wasn't really something that was been mentioned, and we don't see a lot of buzz in the industry as far as, hey, this is a significant thing. Well, I understand it's significant because we understand where the numbers come from our investors, because back in the day, it was a thing to buy rental properties to defer your earnings. I have a good story about this. So my mentor, Tony Forcioni, I started working with him way back in 2003 when I first started in real estate. And Tony was a property management company owner. I mean, not a big property, like 100 doors or something like that, but he was big into sales and big as a retired Army guy. He had done like 30 years in the Army. And what he was doing is when they were doing non-qualifying assumptions to the VA, Parker, this is like long before you were even alive, right?
Probably
Same
so.
with you, Stacy, is they were doing non-qualifying assumptions from VA properties. And they were selling these properties if you could fog a mirror. Okay. So someone who was not necessarily in good standing with the VA because they were missing payments, they couldn't, take the 12, 15% interest payments because we're spoiled. This is back when in the 80s when 10, 12% interest was not uncommon. And so what Tony was doing is he was taking over these assumption properties and gathering all these rental homes. Okay. And he was sucking it up for a few years, and he never did tell me how many he did own, but I can tell you he paid zero in taxes every year because every year they wrote off the expenses, they wrote off the rentals, they wrote off everything they put into the property. They had so many write-offs that he made X and he paid zero in taxes, and he had a good living. And so I use that as an example as you can cascade this technique into a real wealth earning, wealth building scenario. Parker, anything to add to that?
Sure. Yeah. I mean, the first thing that came to mind is that, a lot of people that come to us this is their first time ever investigating this. They don't really know what's at stake. They don't really understand how the benefits work. We talk to them. We explain it in great detail exactly what we're doing and how it's going to work and understanding their situation. And then when they get the study done and they see the results at the end of it, they go, oh my goodness, this is insane. And then almost every single time someone becomes a client with us, they keep coming back and keep coming back and keep coming back. So I've seen it just from a business standpoint. It's like once we take on a new client, we're almost guaranteed to see them back and returning, whether it be later that same year or the next year, because it's like once you get a taste of what's really available to you through it, and you realize that like, oh, this is a real strategy that I could utilize, and it's just available to me as a byproduct of me being an owner of a rental property. They just eat it up, and then this becomes part of their strategy going forward every
Yeah.
single year in perpetuity. So,
And you could just be, Joe Schmo off the street. You do not have
sure.
to be a full-time real estate professional. Am I correct?
Yeah, no, you definitely don't. I mean, there's definitely nuances in how different things will apply, but no, I mean, you could be somebody that just inherited a property. Maybe you're not even a landlord, you just became one accidentally. You inherited a property, or you're part of a trust, or like I said, maybe you just rent your basement to your cousin, right? Even the most simple, basic rental property examples could qualify, right? So it works on both sides of the scale. So,
Fantastic. So before
yeah.
we close this out, what did I miss? What do you want to tell us next?
That's a great question. I would say that the biggest thing that you brought up earlier that I would like to touch on is that, this is something that has been around for decades. It's just now with things like the Big Beautiful Bill passing, now with just access to information that we didn't previously have. I think people get that misunderstanding, or their CPAs even will get the misunderstanding that, I don't know if this will actually work. I think it's really a matter of ignorance, not, oh, is this an actual legitimate strategy, right? So I think that that's the biggest thing, is that, people hear all kinds of different myths and they're not sure whether to trust their CPA or their neighbor or their friend who did it or what they read on the internet or heard through a podcast like we're doing here. Regardless where you heard from it, I think it's interesting to, or it's worthwhile to at least investigate, right?
Yeah.
So that's
And
that's
so
the biggest thing I'd say on
all,
that.
and also the IRS does not see the homework. Okay. And I'm not saying they're doing anything wrong, but they don't see the book report. They don't see the PowerPoint slide. They just, in the IRS software, it's just literal numbers. Okay. Here's form number 12J Bravo something. Okay. And then a bunch of zeros and squiggly lines go in there. And that's what they're going to see. Now, if they come back and ask questions, or your CPA wants to understand it more, yeah, they can review the homework, because what you're going to get from a report from Parker's team is obviously a significant report on, here's how we came up with this particular number. This is what is, the references that are going to go into the tax code if you need that. So it really is something that's going to be pretty easily defended if you need to, or at least justified.
Yeah, absolutely. We even
Yep.
will sit down with the client and the CPA at the same time and go through everything line item by line item if needed, and even CPAs are some of the most eager people to learn about this, right? Because
Yep.
they're seeing what it's doing for their clients, and it makes them look really good to be able to help save their clients money on taxes. So yeah, I would say if you or your CPA are interested in learning more, feel free to make an inquiry, get in touch with our team, and Brad will have some information on how exactly you can learn more. Even if you just want to ask a very casual question that you think would help you guide you in this conversation, definitely feel free to reach out. So.
So let's throw the information out there. How do they best get in touch with you to find out if this is a right situation for them?
Sure. Yeah. So you can go directly to our website, remotecostseg.com/schedule. That's where you can pull up our calendar to book a call directly with one of our advisors. I also would like to be a direct resource to you. If you want to contact me directly, you can send me an email, parker@remotecostseg.com, and we'll be able to take it from there. And I believe Brad's also working on getting some things started so that for his clients, existing and future, will be able to use this as a resource going forward. So glad to be partnering
Absolutely.
with you guys, and I'm glad that you brought me along on this to help teach your clients a little bit about what's available to them.
Much appreciated. We did have some deep questions in there, and I would say for the ones that didn't get answered, to reach out to you. You can probably explain them better than what we could do quickly on a webinar like this. And well, at the end of this, what we're going to do is we're going to have it all recorded. We're going to build out a website on our page. It's going to be rentwerx.com/cost seg, and we'll have the video, we'll have the show notes, we'll have Parker's information in there, so folks can get that and see it very quickly. Okay, and thank you, Stacy, for posting that to the panelists. Anyone interested in getting in contact with Parker or Remote, yeah, you can go there. Did I miss that, Stacy? Did I get that out clear enough? Okay, she's nodding her head. So to wrap this up, everybody, I appreciate you watching the webinar. It will be posted onto the website so you can revisit, and feel free. I would encourage you to reach out to Parker and kind of find out if this is right for you, what it's going to cost, and what your savings are going to be. And it all depends. Okay. We hate that pricing model at RentWerx, but it is so true in this situation. And it's all changed from the big, beautiful bill, which is super exciting. So, any last minute comments from the panel? Parker, thanks for attending.
Of course. Thank you for having me. No, I'm glad we had this conversation. Thank you.
Appreciate it. Stacy, Arturo, thanks for joining. And until next time, we'll see you then. Take care.
Beautiful.
Bye.